Great. Welcome everyone to the role of Bitcoin in the modern portfolio. So I'm George Calle. I lead the client services and engagements at The Block, which is a digital asset media, research, and data firm covering the digital asset space. So today we're really excited to talk a little bit about how investors are accessing Bitcoin and other cryptocurrencies, really who these market participants are, and a little bit about the demographics and data there. Then we want to talk a little bit about the institutional side, how firms are servicing this space. And then finally, kind of what other products may be on the horizon in the cryptocurrency space. But before we dive into that, I want to quickly introduce our esteemed panelists. So first we have Anthony Bertolino, who's VP of Growth at iTrustCapital. We have Noelle Acheson, who's Head of Market Insights at Genesis Trading. Chris Kuiper, Director of Research at Fidelity Digital Assets. And Nate Conrad, Global Head of Asset Management at NYDIG. So before we dive in, I just want to ask the panelists to quickly introduce themselves and the firms they represent. So why don't we start with Noelle?
Hi everyone, Noelle Acheson, Head of Market Insights at Genesis Trading. As George said, I have to apologize, this is not my usual voice, getting over a cold, so you'll see me sipping water throughout this whole thing, and if I start spluttering, I beg your indulgence. Genesis Trading, as many of you already know, is one of the leading prime brokers in the digital asset space. We started OTC back in 2013, which was dinosaur times in crypto years. We are the largest lender in the digital asset space, and we now also offer custody.
Awesome. Anthony, over to you.
Yes, thank you for having me. My name is Anthony Bertolino. I'm the VP of Growth at iTrustCapital. We are really leading the way with crypto IRA accounts. So crypto retirement accounts, we're looking to bring them to the mainstream, and it's a new emerging piece within the industry, and it's very exciting. I'm happy to be here.
Thanks. Chris?
Yeah, Chris Kuiper, Director of Research at Fidelity Digital Assets. Fidelity Digital Assets is a subsidiary of Fidelity Investments, and this was born out of the need for an enterprise-grade platform to help institutional investors acquire, trade, and custody their Bitcoin and digital assets safely.
Awesome. And Nate, to round us off.
Sure. Thank you, George. Nate Conrad, Head of Asset Management here at NYDIG. For those not familiar with us, NYDIG is a Bitcoin-focused technology and services firm trying to help lock the power of coin for as many people as possible, safely as possible.
Awesome. Thanks, everyone. So to start out this conversation, I want to focus a little bit just on like an overview of portfolio management and the role of Bitcoin. But first, I think it's important, to recognize all investments have a narrative. One of the beauties of crypto is the different narratives it's come to subsume given its anonymous origins and decentralized nature. So I guess my first question is, what is Bitcoin and how are investors accessing its value? And Noelle, if you would kick us off here.
That's an excellent question, George. Without a precise answer, macro investors entering the crypto space are told that Bitcoin is a better inflation hedge than gold, but there's absolutely no evidence of that so far. And in fact, even if you look at the correlations between gold and inflation, you see that gold is not a particularly good inflation hedge either. But what many people overlook is that longer term, gold has been a good store of value relative to other fiat-based assets. And given its characteristics, the expectation is that Bitcoin will too. Only we don't see it acting like that in the market. We see it acting much more like a risk-on asset. And this is a natural part of Bitcoin's evolution. As the macro investors move into the market and start occupying a significant part of the trading volumes, to them, Bitcoin is a high volatility liquid asset that you are going to unload when you need to retreat to safety. But they are not the only investors in the market. We also know that many come in with a longer term view. They do see it as a hedge against change in the fiat system. Retail investors perhaps have a totally different investment thesis. This is one of the exciting things about Bitcoin, one of its most exciting things. It's a lot of things to different people And we're all correct. Everyone is looking at Bitcoin to fulfill something. We don't yet know what it will eventually become for everyone. My theory is that it will eventually become a lot of different things, and that is one of the things that makes it a very unique asset. Some people will use it as an inflation hedge, others will use it as a liquid early technology play, and others will use it just because it's fun to watch the number go up.
Interesting, thanks. And Anthony, I feel like you'll have an interesting perspective here, given that your firm, services retail investors. So, how do you think about the narratives, and does it differ at all?
Yeah, I think narratives are more important now than really ever in the investment landscape, as we've seen retail really just feel more empowered with access on, whether it's Robinhood or any type of platform. We see retail really participating in global markets like we've never seen before. And I think the sort of digital gold meme, so to speak, has potentially reached escape velocity. When we look at society at large, you really need a very scalable narrative or scalable meme to have it sort of reach wide adoption. And I think we've seen that with Bitcoin at this point. In early 2017, I walked around a local university and interviewed students to just say, what do you know about Bitcoin? Tell me, right? Early 2017. And less than 10% had any idea of what Bitcoin was. I think if we did that to a local university nowadays, I would say most might have a pretty decent answer that would probably be relatively accurate. And so, the narrative around Bitcoin, digital gold, the 21 hard cap, I think that's probably here to stay.
Yeah, interesting perspective. And, one of the things I think about is, when I heard about it, it was probably in a, news article about, illicit transactions on the internet. Just last spring, it was probably talked about as a, hedge to global uncertainty. And it's really interesting how, both as more people learn about it, but also global events change, that narrative changes with it. So interesting to hear that. But taking a little bit of a step back, what we really want to get at here is understanding how Bitcoin fits into the modern portfolio. So, Nate, I know you work a lot with financial institutions and funds. What's your perspective on just how portfolio management has changed over the last 10, 20 years?
Yeah, it's a really important question, I think, for the backdrop of people as they approach the asset class. One of the things that, it's been happening so slowly for so long, it's easy to forget about, is just the impact of the falling risk-free rate over the last 30 years. So if you look at markets from a risk premium investing lens, then you study equities over the last 100 years, generally giving you some 4 to 6% return above and beyond on the rate. So if you have a risk rate of 5, maybe equities give you 10% return. If you have a risk rate of 0, maybe equities give you 5% return. And difference between those two periods, as you think about compounding people's savings for 25 years towards retirement, compounding at 5 or compounding at 10, just an enormous difference for people in retirement. And so what you've seen in the last decade or so for financial advisors is them grappling with that new arithmetic of what is happening in my portfolio with a risk rate at 0. I have bonds giving me, call it 0 to 3, and equities giving me, me 5 to 7. And how do I help my clients live? And so one of the things they've been doing is looking for investments away from stock and bonds. This is a big trend in looking into alternatives for the last decade. And Bitcoin is, the 6th or 7th or 8th alternative many of these financial advisor firms are starting to look at, having already gone through private equity and venture capital and private credit and timber and increasingly esoteric assets. That's the journey that we ourselves walk coming to NYDIG was what are additional assets we unlock to create a higher expected return in the portfolio, and that are diversifying and low correlation to the other assets portfolio, so you build a more efficient portfolio with a higher level of risk for a similar expected return. And I think that's one of the main ways that financial advisor or fiduciary is going to look at a portfolio, is what happens when I replace a little bit of my equities or a little bit of my
pips or whatever the case may be with a little bit of Bitcoin, what can I do to the compounding effect over time?
Awesome. Really interesting. And you know, I want to turn this over to you, Chris, because you know Nate mentions the change in macroeconomic conditions. Common rule of thumb is a 60-40 split. Does that traditional approach work in today's environment? What are you talking to clients about, and what are you hearing there?
Yeah, very similar to what Nate was talking about. That 60-40 has worked out very well in the past. We actually just published a research report on this called Getting Off Zero. And instead of starting with Bitcoin, we start with the 60-40. And we say, okay, 60-40 has been great over the last decade. And really, you could go 4 decades. The past 40 years, we've had this declining interest rate environment, what Nate was exactly talking about, which has just been an awesome tailwind for both stocks and bonds. But where are we now? The stock market on many valuation metrics is in my opinion, looking pretty rich. Not to say that it can't continue this way, but I think you're already paying for a lot of those growth expectations, a lot of those high margin expectations. And then on the fixed income side, you have a very low interest rate, so you can't count on that for its coupon, for its yield. That's not even keeping up with inflation right now. We have very negative real yields of around 4% or more. And then, of course, your starting point determines your returns in the future, exactly what Nate was talking about. So a lot of people are looking at this 60-40 and saying this is not going to cut it. And after we published this report, 2 articles caught my eye in the Wall Street Journal. The first one was CalPERS, of course, the largest pension fund in the nation, $500 billion about in assets under management. The article noted that they took their target return down from 7% to 6.8%. It doesn't sound like a lot, but it is a lot in the world of managing pensions, right? And they actually estimate their current mix, their portfolio asset allocation mix, will only generate around 6.2%. So what are they doing? Exactly what Nate talked about. They're going to alternatives. They're increasing leverage. They're looking at things like private debt, private equity. And the second one was LA County. Just a few days later, $75 billion under management in the LA County Employee Retirement Fund. They reduced their investment grade bonds from 19% to 12%. So all of this to say is that you're seeing these institutional investors recognize that the 60-40 may not be enough. They're going to perhaps face some headwinds in the future here. And that's why you're seeing an increase in alternatives. And now, of course, the increase in Bitcoin. Something, in my opinion, is a true alternative asset. It's a bearer instrument. It has the ability to be uncorrelated to all these other asset classes, asymmetric risk reward profile, and then, of course, store of value and an inflation hedge.
Really interesting trends. Before we move on, for the audience, Noelle's calling in from Spain. So I'd love to hear your take on this, given negative interest rates in the ECB and kind of the European context.
Given our painfully negative interest rates in the ECB, and this is something that we're actually kind of used to now. We've been looking at this for some time, which is extraordinary because Europe has a very conservative investing culture. We tend to invest in debt for its yields. And so this has been a big shift in the way we perceive things. I don't know if any of you saw the Chainalysis report a while ago that pointed out that European institutional investors are very involved in DeFi investments. Why? Because of the yields again. And pursuant to what both Chris and Nate were saying, the 60-40 was a rule of thumb back when you wanted some kind of diversification. Diversification is a good thing in investments, in diet, and in various walks of life, probably not so much in personal relationships, but certainly it's something that financial practitioners have to take into account. And what are we diversifying for? We're diversifying for different types of risk. But we have seen on many occasions over the past couple of years that bonds and equities now face the same kind of risks. And there was a moment last year, we can probably all still remember, in which bonds and equities moved in the same direction. That is not supposed to happen, and there's no guarantee it won't happen again. So what are we diversifying for? Diversify, the thing that the alternatives can do is offer a higher volatility, higher risk, higher return, which many conservative funds need just to get the return, especially pension funds. That in itself is alarming, but they're not liquid. And that in itself should be setting off alarm bells. To be investing in risky assets that are not liquid is something that we do not really want our conservative funds to be doing. And here we have an entirely new type of asset that, sure, it's risky, it's high volatility, but it is liquid. And this is the clincher, it is a diversification from everything that moves all of the other asset classes, and that is the economy. The crypto assets, Bitcoin specifically, does not respond to the economic drivers that move pretty much every other asset that portfolio managers have access to. It's not going to change its supply due to its price. It doesn't have any cash flows that you can discount at different rates. It is removed from economic considerations. And that is something that definitely European investors are taking a look at, and not just European investors, investors all around the world, especially those that are going to need to guarantee some kind of returns for their clients, for the pensioners, for the endowments, for the necessary income that we don't know we're going to be getting from the fixed income market. And as we talked about before, the equity market is also looking a bit risky.
Thanks. I think with that, it's what I'm really curious about learning more about is, who's actually investing and who is kind of, accessing some of these services. I want to start on the retail side. So Anthony, what have you seen there?
Yeah, so I think that most people would consider crypto to be a younger person's asset class, that most investors are probably younger. And our data actually says quite the opposite. Our largest segment in terms of age is 45 to 65. So 45 to 65 being our largest population of clients as a segment when it comes to age. Now, there might be a bit of bias in that sample. We are inherently working with retirement accounts, and maybe 20-year-olds aren't often looking for tax optimization or worrying about retirement. So there is a bit of a bias there. But I would say that, the more people that are entering, whatever age that is, it's obviously a good thing. I think that this kind of data shows quite interesting to me is that, boomers and middle-aged people, they really, really love Bitcoin. And if, getting back to the narrative side, the more people that understand this and see it as an inflation hedge or a diversification play or a way to just get out of, say, bonds that might be negatively yielding, however their financial advisor and their financial plan says, it's good that everyone's looking at it, whether young or old.
Makes sense. And, Nate, when I think about NYDIG, you integrate into a mix of some of these retail products, but also, service large institutions. Do you see things the same way? Also, as you guys plan, where do you see the next wave of customers coming from?
Absolutely. I think to use a baseball metaphor, or one question we think about a lot is, what inning are we at in the adoption by retail? What inning are we at in the adoption by institutional? And
maybe if you pull a bunch of people out in the world, you might get guesses that maybe we're in the 6th or 7th inning of adoption by retail, where now through many well-known companies like the Coinbases and Geminis, Binance's, FTXs of the world, there are tens of millions of users out there, if not the hundreds of millions of retail users that are active in the product. On the institutional side, feels a lot more like the 2nd inning, give or take, where you've got a handful, probably single digit, maybe double digit, of insurance companies and endowments, pension plans, and that have made a deferred allocation here at what kind of round to zero as a percentage of their asset base. So
makes sense. Sorry, Nate, we're kind of losing you a little bit.
Years of NYDIG journey of 2017, 2018, 2019, institutions are always coming next year. Like next year is going to be the year. We were wrong for a long time. I would say 2021 to me felt like the year that endowments started to move in a big way. After a couple of years of nobody really wanting to talk to us, we saw a meaningful movement in endowments this year. We saw the first ever pension fund in the U.S. make a direct allocation, the Houston Firefighters Fund. I think that's a really big milestone and sets up for, saying it one more time, ready to be wrong. Maybe next year is the year that we really start to see a really big explosion in traction in the endowment space and maybe a few followers in pensions. But when you zoom out and you found a 20-year horizon, it's possible that we're really still a second inning of tail, and the game hasn't even started for institutional. When you think of what then truly come if you believe in the full potential of Bitcoin as both an asset class and a payments network.
Makes sense. And Nate, we lost you a little bit on the institutional side. So Chris, it would be really interesting to hear your perspective there. When Nate was talking a little bit about the innings analogy, it made me think of the JP Morgan report where they said we're first inning. So do you agree with that? Where do you think we are on the institutional side?
Yeah, generally agree with Nate. A lot of his anecdotes match up with our data. As a lot of Fidelity Digital Assets has run an institutional survey for the past 3 consecutive years now. So we survey over 1,000 institutions from every major segment in the US, the Europe region, and then this past year we added Asia. And so, in short, we're seeing all types of institutional investors getting more exposure or looking to get exposure. Obviously, the biggest ones are the crypto native or digital native firms like the hedge funds and the venture capital firms. But beyond that, the biggest segments we've seen that have the highest percentage are high net worth individuals, family offices, and financial advisors. So looking at those, there are a few more innings in, if you will. We have seen the biggest increase with U.S. family offices just this past year. And this survey, what I'm citing here, the fieldwork was done in December of 2020. So we're also looking at doing our new survey. So this is almost a year old now. But even then, 47% of family offices have adopted. That was up 28 percentage points. And for financial advisors, they're now at 43%. And that was up 20 percentage points in just 1 year. And so, a little color anecdotes behind that. I think family offices are a little more nimble because they're privately held, obviously, as a family office. There's fewer people they need to go to get the green light, fewer red tape or regulations around it. And then on financial advisors, especially anecdotally, as I talk to a lot of these every week, they're hearing it from their clients. So even though they're institutions, it's their clients that are pushing them to investigate this. And so the smart financial advisors out there are saying, I have to know about this. I may need to build out some capabilities here. But again, all of this just shows a broad increase. And also to Nate's point too, talking about pensions endowments, those are the lowest ones. So they're not even to the first inning yet, but we are seeing more increase in interest as well from them.
Makes sense. And we actually have a few questions from the audience around custody. And I think it makes sense at this point to kind of pivot there as we're talking about institutions getting involved in crypto. While we're waiting on Nate's mic to come up, Chris, I wonder if we can stick with you for a minute, because what I've noticed over the past year is really 2021 has been a year in which a lot of major banks have started really seriously, partnering, acquiring, integrating custody services. Why are they doing this? Like, what does this open them up to? Is it just, being a sub-custody provider? Are there trading strategies, client demands? What do you see from your position as a leader in the space, as a driver?
Yeah, sure. So, a little history on Fidelity Digital Assets. It started out when Fidelity as a firm was interested in Bitcoin, and they said in order to understand this, we should start mining our own Bitcoin. So they did some mining, they held the Bitcoin, and they quickly realized, we need to have an enterprise grade solution here to custody these coins. That's what's really missing in the market. And so that's the first thing Fidelity went after. And that's really the base layer for building our business and a lot of these businesses. And to your question, why banks are pursuing custody first, it's somewhat of a boring business, but you want it to be, similar to an airline pilot. It's like you should want your day-to-day to be boring. What's not boring is losing people's Bitcoin or private keys or getting hacked. So thankfully, it's a boring business, but it's that foundational business that then allows other people to move into other areas. So, for example, Fidelity Digital Assets moved into offering collateral agent capabilities in 2020. Other things you could build off of this is data and analytics, reporting, tax compliance. All these things can come off of that. So it's not surprising to us to see other people enter this space. But it's not an easy space to enter either. Even though it's boring, there's a lot of risk management and cybersecurity and all kinds of things that have to come around the service as well.
Yeah, that makes a lot of sense. And you mentioned there are a lot of players entering the space. You have traditional financial institutions. Oh, Nate, we're getting some buzzing from you. Do you mind hitting mute? Awesome. You have institutions trying to offer these services. You have traditional digital asset custodians, but you also have technology providers now coming in and providing custody services and partnering with businesses. So Noelle, what actually is going to be the role of a custodian in 2022? Would it ever get commoditized? Where are you guys innovating on that front?
That's a really cool subject to bring up in terms of the commoditization of custody. Something I've been thinking a lot about recently. And for those that don't know me, I am a total markets nerd, and I do find custody very exciting. You remember a couple of years ago, it was all everyone talked about. Custody was the thing, and no way are institutions going to get involved until custody is solved. And even on the retail side, custody was just a barrier. I mean, self-custody is kind of hard to organize. And you keep hearing horror stories about hacks on exchanges. This was a couple of years ago. Fast forward, custody did get boring for a while because we got it solved. It became a commodity, but I am convinced, now this is just temporary, I'm convinced that Q1, custody will be really sexy again because there's so much innovation going on in what custody even means. Custody in traditional finance is, I'm just going to hold your assets for you. I know they're yours, and when you want them, we'll move them for you. But in crypto, it's an entirely different thing. It's not even, the custodians are not even holding your assets. They're holding access to your assets. Your assets live on the blockchain. Try explaining that to a traditional custodian, and also try a sympathy to the regulators trying to get their heads around that as well. But if I'm going to hold your keys as your custodian, then surely there's a lot of other things I can be doing for you as well. We're seeing now that we have custodians that also offer yield on the assets there, because you don't have that in the traditional markets. There will be swaps. There will be all sorts of fantastic services that can enhance what we understand custody to be, while at the same time bringing greater returns to the investors. And this is one of the one of the evolutions, I'll say, that we'll start to see in the custody market going forward. We know that many of the large custodians are looking at crypto assets. We know that many of them are going to be launching crypto asset services, and that is fantastic because that brings crypto assets within the reach in a comfortable way to the institutions that we've been talking about. But we also know that it is harder for them to innovate in what they can offer on custody, and the crypto native custodians have from the very beginning seen custody not as a service but as a technology, and they've been coming up with the technological solutions to do that. In traditional finance, custody is not a technology. In crypto, custody is a technology.
Awesome, really interesting. And Nate, I know you were trying to reconnect while Chris was talking a little bit about what banks are doing. Now that they are starting to add some custody capabilities. I saw you guys recently did a deal with US Bank. Curious to learn what the drivers are for them and what you see in the market.
Sure. I think what happened over the coming years in a success rate for the market is that all the traditional incumbent service providers are going to need to have a way to serve their existing clients in a digital asset landscape. And so in markets like equities, there's a very well-trodden path for a U.S. bank to, for instance, offer custody of stocks
from all of the other countries in the world, where they establish a trusted relationship with a sub-custodian for each relevant asset. And so that's really what happened with US Bank. A big milestone, we think, for Bitcoin, seeing really a Big 10 bank in the US come in and begin to serve their clients live in the market today. A corporation can call up US Bank, face US Bank as their trusted service provider, deposit Bitcoin, and have it live under the hood in case in NYDIG's technology conceptually could other institutional custodians as well. I think US Bank is not going to be the last one of those that we'll see. It is a slow, long, hard process. Many kudos to US Bank for leading the way there. But I think you are going to see other forward-thinking banks maybe into 2022 come to market with that and offering. And as you think about the role of Bitcoin in the portfolio and for these big allocators, like we talk about the CalPERS and the other big pensions and funds, insurance companies, being able to access Bitcoin custody through a name like a US Bank, we see as one of the big things that will help unlock the institutions to come off the sidelines and get off zero.
Makes a lot of sense. Anthony, I know we just talked a lot about custody, and mainly this is kind of Bitcoin, maybe Ether, but in the past 2 years, I would say, there's been a proliferation of newer assets with additional properties that provide increased options for things like staking. I know Noelle mentioned some custodians are starting to think about this, but just more broadly, like, how are retail investors looking at these opportunities, and how do they assess non-Bitcoin crypto exposure?
Yeah, it's a really great question. I'd say over the next 5 years, as Noelle said, custody will really get exciting again. Before, just a few years ago, we didn't have custody, and some of the players who are not paying close attention might think that custody is you hold these assets, it is sitting on the blockchain. Now that's relevant for Bitcoin, but what about the assets that are inherently meant to be staked or inherently have some other utility, or in the world of DeFi are supposed to interact with the governance and manage the protocol, right? So I think what the retail investors are looking at, because sometimes they feel that they are a little later on the investment cycle of the digital gold, they get excited about new narratives. So recently, the first thing would be NFTs in the metaverse, right? A new emerging hype cycle led with Facebook's rebranding, where retail wants to somehow be able to invest in this metaverse, and they think they can do that through various crypto assets that are sort of positioning themselves as utility or building out a piece of the metaverse. The second one would be decentralized finance, or DeFi. Investors are very, very excited about new protocols that are going to be disrupting incumbent centralized financial providers, and retail wants to get a piece of that. They say, hey, if software really is eating the world, if these traditional centralized, slower moving companies might be outcompeted by nimble decentralized protocols, I want a piece of that ownership. The final piece is then staking. If my asset is Ether or Cardano, which is inherently meant to be staked in the protocol to secure it and generate a yield, clients are looking at maybe some of these things and calling them internet bonds. There's this new narrative that's barely emerging where people might look at proof of stake coins as this sort of internet bond, and all of this ties back to the custodians. If custodians are stuck just as I will hold your assets, but I will not allow you to interact with these protocols, participate in consensus mechanisms, maybe even participate in governance. We see Coinbase Custody, one of our partners, leading the way, letting their clients actually interact with interact with governance while still being secured with custody. And these are the leaders who can kind of see this future and be able to bring it, whether it's to the institutions or to the retail, are really going to make the difference in the next 5 years. And those will be the sort of market leaders, in my opinion.
Interesting. And as we, Chris, as we think about new products, what impact would you say like a potential Bitcoin spot ETF, or kind of just in this past year, the proliferation of futures ETFs play in the evolution of a modern portfolio? And more broadly, like, how do you see just the channels for getting exposure evolving in the next couple of years?
Yeah, so we've certainly seen, there's a lot of speculation that there was demand for a Bitcoin ETF. And then, as you said, we got the futures Bitcoin ETF, where that demand was certainly confirmed. One of the most successful ETFs in history in terms of volume traded. I think it gathered $1 billion in assets under management in just the first 2 days. So big market confirmation there. And it's easy to see why. I mean, ETFs have been on the uptrend, and flows into ETFs have been unrelenting for years now because of their ease of use for buying, for handling and brokerage accounts. And then obviously with Bitcoin, you don't have to worry about the private key issue. You're basically outsourcing that to the provider. So, it's certainly going to be a big part of the landscape going forward. Up until this point, people have only had the option of holding it themselves. Futures contracts then came out, and then we also have some of the private placement funds. But on the institutional side, I mean, we continue to see demand for holding spot Bitcoin over these other products. And I think you'll continue to see that, especially for the larger institutions, because there's just so much more cost efficiencies there. If you're holding it directly or with a custodian like Fidelity Digital Assets, your cost is going to be so much lower than if it's in a fund or an ETF vehicle or wrapper there. So the other thing too, I mentioned before, like collateralized agent capabilities. So if you hold it directly yourself, you could open up some of these other options for capital efficiency, or as Nate talked about with different tokens or digital assets with staking and all these other kinds of things. So, I mean, bottom line, let a thousand flowers bloom kind of thing. I mean, everyone kind of has the same interest in digital assets, and different vehicles and structures are going to make sense for different investors depending on their needs. And I think you're going to continue to see that infrastructure being built. I mean, look how far we've come just in the past few years, and I can't imagine, how robust a lot of these things are going to be in the next few years.
Yeah, completely agree. Anthony, I want to hear you talk a little bit about, as we see some of these new products come out in the market, you guys obviously think a lot about, the intersection of crypto and taxation. How do you think about creating opportunities for, tax advantage strategies for getting exposure to Bitcoin?
Yeah, so that is really at the heart of the matter and why we're here. When you look at institutional investors, they typically have access to different type of vehicles that sometimes provide various tax benefits. If you look at how a venture fund or hedge fund or different funds might operate, retail investors are typically not having the same tax benefits in a lot of these cases. They're operating outside of these vehicles, especially unaccredited, non-accredited investors. So, I think retail investors typically have to work with a financial advisor or a savvy tax advisor to figure out their best tax planning. Now, I'm not a financial advisor, but I think the low-hanging fruit for retail investors might be crypto IRAs. Now, this is sort of bringing the intersection of crypto with the tried and true IRAs, right? IRAs have been a staple in the US for retail investors for many years. It's the seemingly one way or one of many ways that they can easily get access to tax advantages. Now, bringing that marriage of the tried and true IRA model with the new exciting emerging class of crypto assets is sort of creating this entirely new animal. And we're excited to lead the way with, one of our many partners and many of our partners. And it's just an exciting place to be. And so finally, retail has easier access to these tax advantages, where a lot of them have been maybe waiting on the sidelines for a Bitcoin ETF. And even when something like that goes live, they might be interested in metaverse investing or one of these proof of stake style assets. And it might not be fair for them to have to wait so long for the traditional older vehicles to try to catch up to this new asset class, which is moving much faster.
Makes sense. We're starting to get some really good questions in from the audience. And I want to make sure we build in a little bit of time to address these. So just, quick reminder to everyone listening, feel free to ask away and we'll try to get to your questions. The first one I see is, going back to the beginning of our conversation around, the macro theses for Bitcoin. Chris, I want to get your perspective on, what's giving investors the confidence to invest in Bitcoin given its declining block reward and still minimal aggregate fee generation. So, in other words, how are institutions getting comfortable with that kind of 2140 question.
Yeah, good question. When we explain Bitcoin to a lot of institutional investors, they start tracking and they say, wait, so the final Bitcoin won't be generated until the year 2140, but you're also telling me these Bitcoin that are generated, the newly minted ones, go to the miners, and the miners get that as a reward for, basically helping secure the network. So what happens to the security of the network once the fee reward goes away, or even every 4 years it gets cut in half? So this is, a question that actually comes up every 4 years. And obviously, this is in the future. So I'm proposing two hypotheses of how I think this could play out. But the one path would be that the price of Bitcoin goes up so much that, yes, they're getting fewer Bitcoin, but the price of each one, the value of each one, is so much higher that it outpaces that halvening or that reward subsidy getting cut in half every 4 years and eventually to zero. And the other thing that you alluded to was the transaction fees. So miners also get transaction fees. If I try to send you a Bitcoin, I have to pay a little bit in transaction fees. I think miners, last time I checked, around 10 to 15% of their total revenue was transaction fees. So it's a pretty small percentage of their overall revenue. More of it is dependent on the block reward. But we could see that come up, especially if, I could envision a future where Bitcoin becomes more of a gold 2.0 global reserve currency, where you don't move a lot of it around a lot. A lot of stuff is done on layer 2 or, different scaling solutions. And so therefore, people don't need to move a lot of the core Bitcoin. And when you do, then you're happy to pay a higher transaction fee to do that, because it's an important transaction to make. So that's just two hypotheticals. I think we'll see how it plays out and how the market forces adopt to it. But overall, I don't think it's a very big concern.
Yeah, that's an interesting point. I forget who kind of made this quip, but in reference to what you were saying about Bitcoin moving on other networks, you can look at things like wrapped BTC, that's trading on Ethereum, and say, well, Ethereum sort of de facto then Bitcoin's largest side network, because you have exposure to that asset, on other networks already. So that's a really interesting perspective. We had a really good question about custody, and Noelle, I kind of want to pose that to you. And that's, what are the biggest security issues facing custody players? And looking forward, thinking about talks about quantum computing, creating the real potential that private keys can be uncovered through, massive compute power. How do custodians kind of assess this risk?
That draws perfectly back to the point that we were talking about earlier, that custody is a technology. It's not just a service. And technology does need to solve these things. Custodians are a step ahead of some of the threats that are coming on. And the level of security of the custody we offer at Genesis and many of the others as well, the level of security is actually totally mind-blowing and very impressive. And to be honest, quite intimidating at times also. That is only going to continue along this path as more and more value is held by custodians such as us and others in the industry. Then the security becomes more and more important and more worth investing, whatever it takes. Because again, custody should be boring in spite of all of the bells and whistles and services that you can offer on there. We don't want any negative surprises. What is exciting about some of the security issues is that we are aware of them. There have been so many very unpleasant and frightening headlines that we've seen over the past few years that have made us all aware that you should be careful of which exchanges you leave your keys with. And the whole not your keys, not your coin, that is something that needs to improve in terms of the user experience, but it will improve in terms of the user experience. And so by this time next year, custody will be varied. Custody will be a lot more secure than it is today, even though today it is indeed very, very secure already. And we will have different types of insurance. The insurance companies have been slow to offer insurance on crypto custody, even those held in very reputable institutions, because they've needed some time to get their heads around the technology here, as well as the assets that are being protected, but that is changing. I mean, NYDIG, for instance, work with many insurance companies that are no doubt looking at how they can service this very rapidly growing industry. And we talked about institutions before, and one thing that we sort of haven't yet stressed is that institutions is a very vague word that covers a vast range of types of investors. Some of them are very agile, as Chris pointed out. Others need to move a lot more slowly, as Nate well knows, the insurance companies, the pension funds, the endowments, etc. And this is going to not only change what types of custody services can be offered, the security that is offered, the insurance that is offered to cover them, and the overall comfort of the next wave of institutional investors, the ones that have not yet taken that step because they're waiting for precisely that evolution.
Really interesting. And I'm seeing a few questions come in, to the tune of, will Bitcoin remain king? And it makes me think, I'm curious to hear really anyone out of this group's perspective on how you guys assess providing services around other cryptocurrencies and what your process looks like for that.
Yeah, I mean, I'll chime in there that, we do service retail investors. So we have a very robust process of listing assets, and it has to hit quite a few check marks. But inherently, we do want to provide what clients are asking as long as it does fit those parameters. In regards to explicitly looking at the flippening or something like that, people are expecting to occur, it's hard to say who might be king. I think there's so much exciting innovation in the space. We do see a lot of development in the application layer of Ethereum, but we see new blockchains arising, and we see Bitcoin looking to build out its layer 2 infrastructure. At the end of the day, all the innovation and competition just breeds more innovation. So I think it's a net positive in the space. And I personally am not too worried about who might be king, because I think they're maybe serving different verticals at the end of the day. And right now it might seem that they're doing the both. They might be doing the same.
Yeah, and I totally agree with Anthony, if I can jump in. And it depends a bit what you mean by king. Bitcoin has the largest market cap, and it will probably hold that position for quite some time, but it certainly is not a leader in performance. However, Bitcoin is the on-ramp for conservative investors. It's the easiest to access for many retail investors as well as institutions because of the protections. It has the widest variety of on-ramps at this point in time, although that is likely to change. But one thing that is likely to change the retail interest that Anthony has referred to is the whole boom behind NFTs, as well as the metaverse, which is a massive trend this year. You've probably seen that Collins has made NFT the word of the year, even though it's not technically a word. But anyway, that's a different conversation. I think next year is going to just see more of this and the overlap of NFTs in metaverse and gaming. And we all know that gaming is one way to get new technologies totally mainstream. And when we start to have crypto assets that can share custody services, share perhaps IRA accounts, who knows, with some of the more utility, some of the original crypto assets, then that's an entirely different paradigm, entirely different opportunity as well for all of those who are working in the space as well as investing.
To build on the question, what does it mean to be the king? Different tokens represent very different investments. So the way at NYDIG we think about Bitcoin is as an open source form of monetary policy. Whereas when you think about a different network, like let's say an Ethereum, Cardano, Solana, and the likes, you look at those maybe more as open source compute networks. And if you ask the question specifically within the realm of a monetary asset, to us, Bitcoin is largely already borderline won that from a network scale and adoption perspective. Whereas the race to be, the world's open source computer in a lot of ways feels very much still in the running between Ethereum and some other blockchains rising to compete with it from a scalability and transaction fee perspective. In terms of how at NYDIG we think about what other assets we might support, we approach the market from a slightly different place than other companies. Not to say that any other company is wrong in their approach, just solving for different things. And so in our particular role, we see our job as providing a solution at the highest level of regulatory compliance and institutional standards to make it safe for some of the most conservative institutions like the banks and insurance companies to get off zero and enter the network. And to be able to do that job effectively, we're not meant to be at the cutting edge of adding new tokens that haven't yet gained regulatory clarity, achieved technological stability and the like. And so I think you can expect NYDIG to be non-dogmatic, but very, very thoughtful and conservative in what we support. And so today that is predominantly Bitcoin with a few other capabilities for select institutions.
You're muted there, George.
Thanks, Chris. Nate, I was just saying, now that we have you back and your audio is much clearer, one thing I'm kind of curious about, we've talked a lot about, banks using Bitcoin and servicing institutions, but I know you guys serve, a pretty wide and diverse array of clients. What are like fintechs, corporates, like what are other types of institutions using you guys for to get, either their customers some sort of exposure or product for crypto or just otherwise?
Sure. This is a topic I personally get really excited about. I think corporates and fintechs over the next year, there's going to be an explosion of new creative things. But ultimately, at NYDIG, our job isn't to come up with everything cool. We're a platform company. We want to give the capabilities and let them run wild. One exciting thing happening, there's a restaurant group called Landry's. They're rolling out for their rewards program the ability when you pay for dining at their restaurants to get points denominated in Bitcoin instead of in dollars. And so this idea of loyalty programs having a flavor of Bitcoin is a great way to make it safe for retail investors to enter the space. They're not paying money for the Bitcoin, they're getting the Bitcoin for free as part of their regular activity. We love that. In fintech companies, you see people rolling out not just the trading platforms that have really started to proliferate, but also really creative things like if you have a savings account, maybe the savings interest can be paid in Bitcoin instead of dollars. Maybe other different flavors of loyalty in the fintech space as well. Maybe it's payments, maybe it's remittances, but an explosion in the types of things you can do with Bitcoin and the different ways you can acquire them and the number of places in your life that you'll be able to engage with the network.
Makes a lot of sense. And I find that really exciting too, because, from these types of organizations, you're just going to see more creative uses that, as you mentioned, you can't really expect always. So, we look forward to keeping tabs on what you guys enable. But Noelle, I want to make sure you have a chance to finish your answer because we cut out for a bit.
No, thanks. My cough very obligingly waited till I was at the end of my last sentence anyway, which I am grateful for.
Awesome. Well, with that, I want to make sure, we're able to end on time. This has been in my perspective, a really, really interesting conversation. So I just want to thank all the panelists for joining us today. We're going to post this conversation on YouTube for you guys to access. And feel free to reach out to us, the block, or anyone here if there's anything more you want to learn about their services or other insights that we didn't have a chance to talk to. So thanks everyone for joining and look forward to doing this again sometime soon.
Thank you.
Thank you. My pleasure.
Thanks for having us, George.
Awesome. Bye.